Hey everyone, welcome back to Corporate Decoder. Today WWD just filed an 8K detailing a significant debt issuance, and I am seeing a key risk signal that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is taking on a lot of new debt all at once, and the terms might tell us something about their future flexibility. Alright, so this is a current report filed by Woodward Inc. It is like a public announcement for big, important stuff that happens between their regular quarterly or annual reports. The main event here happened on the 19th of August, 2026. What happened is Woodward entered into what is called a note purchase agreement. Think of it as a deal to borrow a huge amount of money. They are borrowing a total of $450 million. This is a substantial amount of money. This debt is senior unsecured, meaning if things go south, other lenders get paid back before the holders of these specific notes, but they are still in a fairly good position among unsecured debts. This $450 million is broken down into three different types of notes or loans with different maturity dates. There are Series U notes due in September 2029, Series V notes due in September 2030, and Series W notes due in September 2033. So they are spreading out their repayment obligations over several years. The closing, meaning when they actually get the money and the deal is finalized, is set for the 30th of September. 2026. Now let's talk about the cost of this borrowing. The interest rates are not fixed for the entire term. For the Series U notes, the base interest rate is 5.34% per year. But here is a key point. This rate can jump up to 6.09% if the company's debt to EBITDA ratio goes above 3.5 to 1.0. EBITDA is basically a measure of a company's operating profitability. So, if they take on more debt relative to their earnings, the interest they pay goes up. This is a common feature in corporate debt to protect the lenders. If the company's financial health deteriorates, the cost of borrowing increases, making it harder for the company. The Series V notes maturing in 2030 have a slightly higher base rate of 5.39% and can go up to 6.14% under the same leverage condition. And the longest term notes, Series W due in 2033, have a base rate of 5.64% and can increase to 6.39%. It is interesting that the longest dated debt has the highest base rate, which is generally expected due to the longer time horizon for potential risks. Interest payments are scheduled twice a year in March and September, starting in March of 2027. This means they've got a little grace period before the first interest payment is due. This means that these new notes are on equal footing with the company's other unsecured debts. They are not getting a super priority status, nor are they being pushed to the back of the line. Now, let's talk about the rules that come with this loan. The agreement has what are called restrictive covenants. These are basically conditions that limit what the company can do. They're pretty standard for this type of borrowing. For instance, the company will have limits on how much more debt it can take on that leverage test we just talked about is part of this. They also have restrictions on selling off assets, merging with other companies, or making big deals with related parties. These covenants are there to protect the lenders by ensuring the company doesn't take on excessive risk. Specifically, there are financial covenants requiring Woodward to maintain a certain level of net debt compared to its consolidated EBITDA. The filing notes that these are consistent with their existing unsecured debt. This suggests they are trying to keep their borrowing profile consistent rather than dramatically changing it. Like most loan agreements, this one has events of default. If any of these events happen, the lenders can demand immediate repayment of the entire loan. And here is another consequence. If a default occurs, the interest rate on these notes will automatically jump up by an additional 2%. This is a penalty for not meeting the loan terms and further increases the financial burden on the company. To give the lenders more confidence, two wholly owned subsidiaries, MPC Products Corporation and Woodward HRT Incorporated, are guaranteeing these notes. This means if Woodward itself can't pay, these subsidiaries' assets could be used to cover the debt. Woodward does have the option to repay these notes early, in whole or in part. However, when they do, they have to pay back the principal amount plus accrued interest. There is also a mention of a prepayment compensation amount and potential losses related to cross-currency swaps, which suggests there could be additional costs associated with early repayment, especially if interest rate environments have changed significantly. This section just confirms that the deal we just discussed creates a direct financial obligation for Woodward. It is essentially reinforcing the information from item 1.01. And finally, the actual legal document, the note purchase agreement, is filed as an exhibit. Some parts are redacted because they are considered confidential or not material, which is pretty standard. Looking at the research context, Woodward Incorporated, ticker WWD, has a pretty solid market cap of $20.3 billion. A P/E ratio of 38.2 and a current price of $343.26. They employ over 10,000 people. Recent headlines show mixed sentiment, one from the 19th of August, the same day as this filing. From Chartmill says they stand out in quality investing despite tepid revenue growth. However, other headlines on the 20th of August from Quiver Quantitative and Guru Focus suggest the stock was down, with Guru Focus noting it was still overvalued by their GF value metric. Yahoo Finance also reported a plunge on the 30th of July. This shows investors are a bit divided on the company's current valuation and prospects. Large institutions like BlackRock and Vanguard are significant holders, indicating strong institutional belief. So, what is the story here? Woodward is borrowing a substantial $450 million. The key takeaway is the interest rate structure. It is designed to penalize the company if its debt levels get too high relative to its earnings. This is a clear signal that the lenders are concerned about financial flexibility and want to be compensated if the company takes on too much risk. A comparable situation would be when a company is already carrying a lot of debt and takes on more. For example, if a company like Bed Bath & Beyond in its later stages had tried to take on a similar debt load, the penalty rates would have quickly become unmanageable, accelerating their downfall. For Woodward, a $450 million debt issuance means their total debt picture will significantly change. The fact that the interest rate can increase by over 0.75% based on leverage is a meaningful cost increase. If they hit that threshold, for instance, on the Series W notes, that is an extra $1.07 million in annual interest payments just on that portion of the debt. This isn't necessarily a death knell, especially for a company of Woodward's size, but it does put pressure on them to manage their leverage closely. The risk I am watching is how closely Woodward will manage its debt-to-EBITDA ratio. If they need to spend heavily on growth or face unexpected operational challenges, those higher interest payments could eat into their profits and limit their ability to invest further. What I am actually looking for is how this new debt impacts their ability to service existing obligations and fund future growth without hitting those penalty rates. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives.